Good afternoon, everybody. It's a pleasure to be here in this fantastic city and to introduce a topic that has been keeping me busy over the last 10 years, and also some of you, I have to say. What I wanted to talk to you is about start in terms of how did we develop everything and when we started. So everything started in 2013 when the IAIS commenced the development of the Insurance Capital Standard, or as we call it, ICS. This was supposed to be a consolidated group capital standard for the supervision of international active insurance groups, and it was supposed to be the quantitative element of CONFRE. Since 2013, we have been through 6 years of field testing involving between 40 and 50 volunteers per year, and 3 years on monitoring the ICS. And we currently started the 4th year, and we had 3 public consultations, and as Dana said, we'll be starting the 4th consultation on the final standard. What I can say is that this process has provided the IAIS with lots of quantitative and qualitative data to inform the development, and this is a firmly evidence-based solvency framework for international active insurance groups. The latest version of the ICS, which we call, for simplicity, candidate ICS as a prescribed capital requirement, is the outcome of this journey and the penultimate milestone before the planned adoption of the standard in 2014. Now, what happened since Abu Dhabi, which is the time where we approved what we call ICS 2.0? Let's take one step back in time. So the previous consultation, which we did on the ICS, was in 2018, and the consultation was followed by the release of the first stable version of the ICS, ICS version 2.0, that was supposed to be used for 5 years for the monitoring period, between 2024, 2020, and 2024. And these 5 years were intended as a period of stability in the design of the ICS, and they were deemed to monitor the performance of the ICS, not to monitor the performance of IIGs. The experience of this monitoring period so far has shown that the ICS 2.0 performed quite well, produced consistent results even under stress scenario as we experienced over the past 5 years. Having said that, the monitoring period also showed the need for some adjustment before the ICS is formally adopted and applied in the solvency assessment framework of IIGs. Those adjustments mark the transition between ICS 2.0 and the so-called candidate ICS as a PCR. But what has changed, and what you would like to find in this consultation? We made a few changes both on valuation, capital resources, and capital requirements. On valuation, we made adjustment to the market-adjusted valuation approach. This adjustment involved eligibility criteria for the middle bucket, but also we made significant changes by introducing a term structure or spread for the discounting of insurance liabilities. On the capital resources, we made few adjustments to criteria for financial instruments which have call features. We also introduced limited transitional in the form of grandfathering for financial instruments, and also a limit on the recognition of minority interest. When it comes to capital requirements, we introduced a differentiated treatment for infrastructure, equity, and debt, subject to certain conditions. We also introduced a counter-cyclical measure to the equity risk charge, and also we revised the calibration of certain life risk. We also simplified the approach to tax. And last but not least, we introduced and recognized internal models for the calculation of capital requirements. And this in practice means that in the implementation of the ICS, jurisdiction may provide for the possibility to use internal model subject to a set of requirements and approval by the supervisory authority. Also, when it comes to GAP+, the decision was made not to include it as part of the candidate ICS. However, that approach could be reviewed in the future if supervisor expressed an interest in it. But where are we now, and what are the next steps? As has been announced this week, on the 23rd of June, the IAIS will release for consultation, for a 90-day consultation, the candidate ICS as a PCR paper. And in parallel to that, the IAIS will also release the consultation paper on ICP 14 valuation and ICP 17 capital adequacy. The public consultation on the candidate ICS will also include a set of questions to inform the economic impact assessment. And this is a very important point. It's an opportunity to make your view clear with respect to the impact of the ICS. The input we're going to receive through the consultation, through the questionnaire and the economic impact assessment, and the data received this year through the data analysis will inform the final version of the ICS. So if we see that we need to review the ICS, what we will do next year, we will make some changes. We hope that not many. We'll make some changes ahead of the final adoption in December 2024. And this concludes my remark. So back to. Okay, we'll start now with a few introduction. Vicky, floor to you.
Thanks, Paolo, and thanks for the factual overview that you gave. This is an important milestone, the decision that we reached by EXCO, or that EXCO reached, that we reached as the IAIS on Wednesday this week. We launched the ICS as a PCR for final, and let me stress the word final, consultation. So what does that mean? It means that for those of you who are actually want to still influence its design, you are going to see a number of questions in the consultation paper. These are written in the style of questions when we are at the final stage of consulting. This is no longer in the development stage. We are consulting in order to finalize. So I really, really encourage you to study the document and to answer all the questions with evidence-based answers, because this is the last chance to influence the design of the standard ahead of its finalization in December 2024. As we have already said, and it was mentioned by Matt, the chair of BDC, in the first panel that we had, this is one of the most tested standards that I'm aware of in the financial services industry. It's also highly empirically driven because the calibrations have been driven by the data that the volunteer groups have been providing us over the last 10 years, literally a million observations. However, there is still the possibility that there could be more evidence that could be given to us over this period, and we are going to look at it. As Paolo says, there is also questions around the economic impact assessment. We consulted stakeholders on the scope of that assessment ahead of putting it into the consultation paper, but I'd like also to draw your attention to that part of the consultation paper. So this is happening. It will become, and it will be adopted in December, with any revisions informed by your company's responses, and those, as I said, that are better evidence will receive more weight. There is also 2 more years of monitoring, which, we've already issued the template since March, and those of you who are volunteers already would have seen what the specification of the ICS were going to be consulted on since March, and would have been able to engage with the team on this. We will have a final year of monitoring, where we will gather the final bits of data next year, and then that will be it. I know that a number of you have been asking about transitionals. There will be some transitionals in particular elements of the standard proposed in the consultation paper, for example, on capital instruments for the capital resources bit of the of the ICS, but we haven't yet decided as the IAIS what would be how much time we will give for implementation between December 2024 and that particular date. Feel free to provide input on this, how long it could take to implement. And this is, of course, separate to the timing of the implementation assessments that the IAIS will be doing of ComFrame, of all ComFrame standards, out of which ICS is one. But obviously these implementation assessments will start after the implementation date that we will decide in due course. So let me stop here. Thank you. That's on the ICS. I have also been asked to say a few words about the UK's implementation of the ICS on our IAIGs. The UK has embarked on its own journey now since leaving the EU, and it's revising its own standard, which was Solvency II. We call it Solvency UK. In its structure, it's very, very similar to the ICS. However, when the ICS is finalized, we will study the ICS and how it compares to Solvency UK, and if there need to be adjustments to ensure that we align with ICS for IAIGs, we will do so, and we will do so for 2 reasons. One reason is it has been a long-standing strategy of the UK, which is one of the world's biggest financial services hubs. Basically, it hosts all the big banks in the world, and it hosts many of the IAIGs in the world, plus many other activities, so it's incredibly interconnected with the rest of the world. So as a result of that, the UK strategy is to remain responsibly open to those companies that want to come to the UK to offer services, but in return, we need strong standards. And we need strong standards that for these internationally active firms are going to be consistent with those standards applied elsewhere. And that is why we believe we should be aligning with international standards, and that is ultimately for the benefit of the UK as a financial services hub. And we're obviously doing that in other settings. We are in the process of implementing, for example, the final Basel standards, and we have been extremely careful to align with them, and we will adopt the same approach. The second reason is because our framework and our objectives that are given to us by Parliament are saying explicitly that we should align with international standards. So it's embedded within also our framework since we have left from the EU. And therefore, that is why we're going to be very careful, and we shall align. Thank you.
Thank you very much, Vicky. Shigeru, can you tell us a bit more about Japan and your implementation of the ICS?
Sure, thank you. As Vicky just mentioned, I think the discussion on surrounding ICS has been quite constructive and moving in the right direction. So in Japan, I may have just talked about this last year in Croatia, but we have released what we call a preliminary decision on our ESR, reflecting the discussions on ICS. So we are right now thinking of providing another update by the end of this month, hopefully, on our progress since last year. Of course, for example, we are still in the discussion, so this is just a sort of a sneak preview in a sense. But first of all, on the overall framework, we are looking at to identify the frequency of reporting, and also the term or the end date on when the reporting should occur from the industry to the JFSA right now. And we are also looking to see from the perspective of proportionality to identify what are the less important risks, or the proportionality on the less important entity as well. On the standardized model, we will continue to work through this, building on what he had announced last year. And if there's any changes or developments on the ICS, including, for example, on discount rates, we will look to update that in the next update that we will provide by the end of this month. On internal models, we will look to identify the criteria that we will assess and approve the internal models application. And also we will look to see to introduce sort of a if there's any kind of new introduction, to look at that on a phased manner, not only looking at all risks, but to look at mainly on natural disaster risks. On validation functions, we will look to see the actuarial functions, the role of the actuarial functions within the internal company, and we'll also look to what should be reported from the industry to the JFSA. And we will also look to see external sort of attestation or reasonable assurance by external stakeholders as well. On ICSS PCR, we look to have ESR 100% as a trigger point right now, but we will also look to see what standards we will implement in terms of minimum capital requirement, but that level will probably be decided at a later time. Pillar 2, ESR, we will look at ERM framework or model, or internal model governance, and we'll try to identify what we will look in terms of monitoring those points. And on Pillar 3, we look to identify the risks for required capital, also capital resources, how do you categorize that, and sensitivity analysis and so forth. We will try to make this within the legal disclosure framework. On the granularity, we will have to look further down the road. We intend to publish what we do as a regulation in 2024, but of course we need to have a final look at what the IAIS will look like and reflect that in our final rules. As I mentioned last year, we intend to implement ICS as ESR, hopefully from fiscal year 2025, which means the reporting will begin from March of 2026 in Japanese, which is usually the Japanese business year. So let me stop there. Thanks.
Thank you very much, Shigeru. Gary, can you tell us a bit about the next steps on comparability and ICS discussion?
Yeah, sure. Thanks, Paolo. And a pleasure to be up here with my colleagues who, over the years, have also become friends. I did hear some rumblings once we got to the global seminar piece that the meetings that preceded it, that there were no fireworks and not a lot of drama, almost as a complaint. I would say it's better to be boring, particularly with insurance. But I also think it's represented a certain collaboration that we've experienced over the last number of years, but as we've come upon a milestone, a really important milestone, that we find ways to agree. And so I'm very appreciative of that. And I must say, although there are some open seats, I think only in the insurance sector on a Friday talking about ICS could you get this many people. So kudos to you. Maybe, yes, to Paolo's question, maybe it'd be helpful if I give a little background, go through some of my notes on background, data collection, the comparability assessment that will happen. I'm happy to do that. The March publication of the final criteria to assess whether the aggregation method, or AM, provides comparable outcomes to the insurance capital standard, or ICS, was an important milestone for us and for the global insurance sector. We're confident that the criteria that will provide a viable and a fair path forward for the AM to be deemed outcome equivalent as an approach for implementation of the ICS. And now with the launch of the 2023 data collection and the upcoming public consultation on the candidate ICS as a PCR has been referenced, we're well positioned, I think, to get the comparability assessment underway later this year. So with regard to some of that history and background, and if you go back to the Kuala Lumpur Agreement in 2017, that was an acknowledgement relative to the development of the aggregation method within the U.S., and a commitment from the IAIS to collect data from interested jurisdictions so that we'll be in a position by the end of the monitoring period to assess whether the AM provides comparable outcomes to the ICS. And over the years, the IAIS has repeated this commitment, to which we're grateful, to the development of the AM, and has supported the collection of that data. The IAIS began actually collecting data on the AM in 2018, even before the ICS version 2.0 was finalized, and now we're in the 6th year of that data collection for the AM. The IAIS has also conducted 2 public consultations related to the AM. In 2020, there was the consultation on the draft definition of comparable outcomes and the 6 high-level principles to inform the development of the criteria for the comparability assessment. And then last year, there was the consultation on the draft criteria itself to assess whether the AM provides comparable outcomes to the ICS. And the IAIS has also conducted 12 workshops specific to the AM. I think that's a demonstration of just the amount of time and resources that have been put into the project. More specifically to that data collection and development, the collection of AM data has actually expanded to include 21 insurance groups from 5 countries. So as we committed when we reached the agreement in Abu Dhabi on a process and timeline for developing the criteria for the comparability assessment, all U.S. IIGs have submitted AM data, along with other U.S. volunteer groups. Firms in other jurisdictions have also submitted data, and their supervisors have also aided in the development of the AM. So I would like to underscore that every single US IIG has submitted AM data, and participation in the AM data collection exercises has only increased over time, and that's including non-IIGs and groups that are outside the US, which has been very helpful. The AM data collection includes data that's used to refine the design of the AM and data that will be used by the by the IAIS in the comparability assessment. As we talk often, the AM builds on the local regulatory capital approaches to develop a group view on solvency, and that is, it embeds the wisdom and analysis underlying each jurisdiction's capital requirements, and this allows for a nuanced handling of business, particularly long-term life business or insurance that has proven a little difficult to handle in standardized approaches to group capital. And in working with AM volunteer groups has refined the connection between the AM inputs and existing reporting. And what this does is it ensures the efficient and accurate reporting of the hundreds, or in some cases, thousands of entities that make up each group. Also, benchmarking against existing measures of group capital adequacy has provided empirical confirmation that the AM provides a robust indication of an individual IAIG's solvency. So the AM has been refined by analysis on the provisional AM, which is unscaled, as we know, and 8 methods that represent the full range of reasonable ways of scaling local capital requirements. Scalars have been calculated for the 53 AM entity categories for each of these 8 methods. Analysis is being conducted using a framework from a 2021 paper from the American Academy of Actuaries on aggregating regulatory capital requirements. And the goal of that, the goal for the final AM is to select scalars that are meaningful from a prudential point of view, and also relevant for monitoring of financial soundness and help to provide comparable outcomes to the ICS. So specifically on the comparability assessment, as we look forward, the assessment of whether the AM will provide a comparable outcome to the ICS will begin later this quarter. By March of 2024, the ICS task force will be in a position to adopt a report to EXCO on the comparability work performed based on the 2023 data. And then in September of 2024, the IAIS will issue a final comparability report reflecting changes made to the ICS and or the provisional AM. And then EXCO will make a decision in December of 2024 as to whether the AM provides comparable outcomes to the ICS. So we expect the comparability assessment to be based on a robust, technical, evidence-based analysis. The analysis will, as we've said, use the provisional AM and the candidate ICS as PCR, reflecting, of course, any revisions made for the 2024 ICS and AM data collections, and that includes results from the public consultation on the candidate ICS. So the work of the IAIS and AM data collection, the development of a definition of comparable outcomes and high-level principles, and the finalization of the criteria for the comparability assessment highlights the consensus that we've maintained across the membership on a really important issue. We know the resources that have been devoted to the AM, not just by the US, but also by the IAIS and other interested jurisdictions, help to ensure we have a common understanding and a strong foundation for a comparability assessment. And throughout the process, we've received useful input from you as stakeholders who are interested in the recognition of the AM as providing comparable outcomes to the ICS, as well as the broader insurance market. So we thank you for your engagement, and we look forward to continuing to collaborate on the protection of policyholders. The collective contributions of us all to this work do lend credibility to the comparability assessment, with a view to fulfilling the Financial Stability Board's charge to develop a comprehensive, group-wide supervisory and regulatory framework for IIGs, including a quantitative capital standard. And lastly, with the U.S. using the AM to calculate group capital for IIGs and the recognition of the aim as providing comparable outcomes to the ICS, we would have a single group capital standard. So hopefully that covers it, Paolo. Thank you.
Thank you very much, Gary. Petra, can you talk about the EU and ICS implementation?
Yes, thank you, Paolo. Thanks everyone for being here for, I think, an important panel, because I agree with Gary. Maybe sometimes things are a little bit calm, but I think it's a lot of effort there, both in getting to know each other, being willing to talk to each other, being more even willing to listen, and then finding the right words. And I think we did. And as a result, I think we have a lot of words on a paper that we will publish, and that you can now listen. And then we hope to hear from you. So I think this is an important milestone, but it is a step on the way where we also need you and your input, as you have been providing, both in the form of data as well as feedback already for many years. So thanks for that. Let's keep doing that. And where does that bring us today from an EU perspective? Well, from an EU perspective, naturally, we are also monitoring developments in ICS, and then at the same time looking at our own framework, Solvency II. Asking ourselves the question, would the consultation, the ICS as a PCR as it stands today, how would that fit into Solvency II? I'm very happy to say that considering that internal models is part of the ICS as a PCR, it would actually fit very well. Indeed, as Paolo said, including internal models with all the safeguards that should come with the use of internal models, including model approval, major model change approval, etc., etc. Again, lots of words on that, but that is of course part of internal models, but then it is also part of trying to get to a regulatory framework that really fits to the risk profile of particularly large groups that sometimes have a specific risk profile, but then also should be capable of modeled properly. So with that included, I think Solvency II fits very well with the ICS as it stands today, and I think that is of course good news. For those who are a little bit more involved in EU Brussels dynamics, you would know that there is a review currently ongoing of Solvency II, and that is in a stage that we are waiting for the Parliament to come up with one text in order for negotiations between Parliament and Member States to start. That has not gone as speedy as we had hoped, let's put it like that. We'd hoped for a conclusion in Parliament last year, November, but so far that has not happened. Yet, I think what we do see is we see that in the dialogue that is taking place in Parliament, there are proposals on the table, and there is a bandwidth between those proposals related mostly to how much sustainability and how much capital requirement change do you want in the review. But I think those two data points, a lot, not so much, are clear, and I think within that bandwidth, if you then look back at ICS when it comes to the capital requirement, I think it still fits, and I think that again is positive. So all in all, I'm very happy that we are here on the ICS consultation paper. Many tend to ask me, Petra, is that actually still moving? Oh yeah, it is. We are here. We're happy to hear from you, and I give it back to you, Paolo, for any question that the audience may have.
Yeah, thank you very much, Petra. And let's open now to the audience. Any questions? Volker.
Thanks a lot, Volker Kutschus from S&P Ratings. Petra, a question to you. Recalling that around 12 months back you said obviously it's not even a well-fit. ICS will be as Solvency II, or as Solvency II will be ICS. Where we see differences still in detail, maybe with regards to capital instruments, what have you, will Solvency II move, or will the final tweaks of ICS made fitting, because there seems to be still some differences in the two standards? Thank you.
Thank you for the question. I would say, first of all, ICS is a minimum requirement. If there would be a difference in Solvency II, because it's a bit more prudent, I don't think anything has to change, although that is a decision, of course, not for the supervisors, but for politicians. As I said a year ago, if we really see that there is a need to change because we have adopted the ICS, then it should be Solvency II that needs to be changed, again, in the hands of Brussels. But clearly, in the end, agreeing with an ICS would already have that notion in it if EU says yes.
Thank you. Steve Brody?
Thank you. Steve Brody of APCIA. Just a question regarding timing for Vicky. I believe, and I think I heard you say this earlier yesterday, you mentioned that a final decision by the IAIS would be made in December. Now, is that December 2023 or 2024?
December 2024 will be, because obviously we will need to consult first, and for 90 days, then take into account what we learned from the consultation and take into account what we learned from the final year of data gathering before we finalize. And also the finalization of the ICS needs to coincide with the finalization of the comparability assessment that Gary actually set out, which is quite an involved exercise. And as Gary says, it will start later this year, but it is an involved exercise. And that is why it is end of December next year. But I should clarify that this is exactly on track with the timetable we issued at the end of 2019 in Abu Dhabi. So basically no change to that timetable. Thanks.
Next. You, Francis.
Thanks, Paolo. You, Francis Aviva. Two questions, slightly building on that. 2024 monitoring, you thinking about, I mean, obviously this year we're effectively doing version 2.0 plus candidate ICS. For 2024, and I know you're finalising the consultation, will you potentially make revisions and then do final ICS, or still do ICS 2.0 plus candidate ICS plus something else if that changes? I.e., have you still got the capacity, if you spot things in the 2023 exercise, to retest anything in 2024 before you finalise? I was just trying to think about how 2024 will rule itself out. And then the second question, I know there's a significant difference between like the comparability assessment and for those jurisdictions that have some, between the AM and that's kind of like outcome equivalency, or outcome equivalent outcome in kind of like position. When it comes to, and I was thinking Petra for yourself or for the Japanese system or for the UK system, when you assess what will end up being the final revised local regime against the final revised ICS, will you be looking at that in terms of outcome as opposed to everything being exactly the same? And I just wonder whether you started to think about that, because we know already there are things that are slightly different, but it may mean that actually in principles they're very similar. I just wonder if you started to think how at the local level you would start thinking, comparing, because I think you, Vicky, mentioned that you may look at whatever happens in Solvency UK and then think about how ICS. Similarly, Petra, there will be Solvency II European as 2026 revised. I just wondered if you're looking at that in terms of holistically the outcome or specifically everything being the same.
Okay, I'll take the first question, which I think is pretty straightforward, which effectively, what data will we be collecting for the final year of the monitoring period? Now, if everything goes according to plan, so we'll have to make some, and even if you have to make some tweaks and some revision, the idea is to collect only the final ICS and to park for the last year the reference ICS, and potentially operating on a more compressed timeline because we'll be cutting in half the amount of things, considering that we will need a bit more time on the ramp up to the December AGM to approve that. So the idea is, if everything goes according to plan, only one version, not like this year, reference ICS, surplus ICS, and all volunteers should be happy about that. The second question was what about the implementation assessment? Any implementation assessment, and I don't think we have decided how this is going to happen, always look at line by line in terms of reading the differences, but they take judgment at different points in time. And I'll let Vicky to complete that.
Yeah, so the aggregation method was the comparability assessment exercise in relation to the aggregation method, as Gary very eloquently set out, was a specific agreement that was made in recognition of the move towards a group capital calculation that the state supervisors had agreed in 2016. And then subsequently, there was a decision, there was the development of the principles, the criteria, the quantitative criteria. Now we're starting the process. This process is all about actually comparing the ICS as a single standard against this aggregation method, which at the moment the US is developing. Now, this is a distinct process from the process of the implementation assessment of ComFrame, under which the ICS is the quantitative pillar of that sort of underlines ICP 17, which is the ICP that we are also consulting on next week. And the exact methodology that we are going to be adopting under this is not something that we have decided upon yet. But it's highly likely to, and indeed we haven't yet decided on the timing of that, implementation assessments, although we have decided that we're going to be doing implementation assessments because that's the bread and butter. So the exact kind of methodology and how exactly we're going to take it, not decided yet, but it's very likely to be informed. Well, it's certainly going to be informed with the way that we are doing implementation assessments already. So basically comparing what the standards require and then having an assessment of whether you're non-compliant, whether you're compliant with deficiencies, largely compliant, fully compliant in these particular elements. Now, once you have a quantitative standard, there needs to be more work and a methodology to be built up, which we haven't agreed, which could include an outcome equivalent type of approach. And last but not least, I've got to emphasize the point that Petra said. This is a minimum standard. So it's not jurisdictions, of course, that go above that standard, and their underlying standards aligned with it will, of course, be compliant.
Thank you.
Thanks.
Next.
We could always end early.
Can see any questions?
All clear? Oh, yeah.
Yeah.
All right.
Marek.
I don't think we complain about ending early.
No.
Morik Fullilove with the Fullilove Consulting Group. Yesterday we had a session on IFRS 17 that OSFI presented with Lesotho and a very clear explanation of how they proceeded through the comparison of IFRS 17 and sort of the mapping process. We haven't heard very much recently about, and I'm sure it'll be in the consultation paper, but about GAP Plus, or whether or not, as part of this, IAIS might undertake a similar mapping of IFRS 17 to ICS realizing it, of course, will be applied differently in various jurisdictions. So I'm just saying, IFRS 17 is being implemented. More jurisdictions are considering it, and we haven't heard much comment about it recently.
I was not clear with you in my remarks, but I mean, when it comes to GAP Plus, we decided to park discussion on GAP Plus for this standard, but at the same time, we stated that we're quite happy to reconsider it at another point in the future if there is interest from supervisors. But when it comes to this standard, there's one which is going to be implemented starting from 2024, GAP Plus will not be included. Questions? More questions? Can't see any hands. Final call.
Hi, Michael Van Veeren from FWD Group. I wonder if the panel could please comment a bit more about the expected implementation approach, timeline, and transitionals.
Thanks. Petra, would you like to take this one?
I can try. Yeah, so first we need to get to, of course, a final ICS. But once we have that, I think as Vicky already said, it's not uncommon for the IAIS to assess implementation, in this case of ComFrame, of which the ICS is part. Now, I would say I do not expect, also from a resource perspective, that on the 1st of January, all jurisdictions are starting to be assessed for implementation, but I think there will be an order and we need to decide how we organize that. So whether or not we start immediately, who starts first, I think that is something to be decided upon. But if you say, how are you going to do it? There is an implementation committee at the IAIS that assesses implementation of our standards, and in this case of ComFrame. And I would see that the logic of that project, a team dropping by, looking indeed line by line and then saying, fully compliant or partial, or and then reports that back to the IAIS committees, I think would be a very logical way forward. So that's one. On transitionals, I think there are different ways to talk about transitionals. There is, and you will find them, by the way, in the consultation paper. There are in the framework some transitionals or grandfathering included that should help to make a move into the ICS for those jurisdictions who are working on that. That's one. Second, that is not so much, I would say, transitional, but it's just time that you need to implement it in a jurisdiction, which could also be that there's just simply some time needed for your parliament to get a change approved, etc. But I think that is time for implementation that is different than a transitional. And finally, I think you could say that in some jurisdictions there could be a specificity that may need a different way of making sure that in time you would be completely compliant. But I would say that in the assessment you would call that partial compliant for the time being, because the idea is that if there is a transitional included, it should already be in the framework. Hence, I'm looking at you if you want to add anything, Paolo, but I think that is why this part of the consultation, I think, will also be very relevant to hear back from you on.
What is also quite important is, as we mentioned, the final section of the consultation document contains question on the economic impact assessment, which will inform the economic impact assessment. So the last question about related to the implementation of the standard as set out in the document. So the answer to this question are quite important because it will also inform any discussion related to potential transitional. So worth to remark that. I think we got time for a final question.
I think it's very calm in the room.
No? No final question?
Hugh wants to ask another one.
A third.
He sees an opportunity.
It was just a point of clarification to understand. Petra, fully agree in terms of the real merits in basically be able to use internal models to get that reference from how companies manage their risk, especially for large diverse groups in terms of capital requirements. Just wanted to understand, in terms of the Japanese Financial Services Agency approach to that, were you saying that's something you will give consideration to, but over a phased period? There are certain elements you may look at first, like NatCat. Just wanted to understand what the direction of thinking in Japan was in terms of internal model. Obviously understanding the caveat that whatever, it would need to go through a supervisory, robust process, have a good process on approval, model change. I just wondered what the appetite was for that from a Japanese perspective.
Okay, thank you very much. Your question is about how do we think about introduction of internal models and how we think. Yes, currently our thinking is that we would like to have the ICS. Of course, it's measured against the implementation assessment in terms of COM frameworks, but our intention is to put as much as possible in the implementation that we have for fiscal year 2025, and I think that is also included in terms of the internal model. But we have to kind of, that's our basic thinking, but we would have to decide in the end what we do propose as a final regulation, which will come in 2024 on that point as well. So the direction is to try to implement it from the beginning, but our final decision we'll try to make next year.
Thank you very much, Shigeru. This concludes our panel. I would like to thank our panelists, starting from Vicky, Kari, Petra, and Shigeru. Thank you very much.